wholesale prices surged in November. It will likely get the attention of Ben Bernanke, who arrived just a short time ago at the Fed's two-day meeting in one of these two SUVs.
Not the second one.
Could this mean a rate hike sooner rather than later? John Lonsky, Moody's Capital Markets Research Group Chief Economist, and Brian Westbury. Yep, got the beard, the goatee, the mustache, the whole 9 yards. First Trust Advisors Chief Economist. Brian, I'll start with you.
Sure.
Are we getting to the point where they need to start worrying about raising rates?
I think so, Mark. I mean, we are in a full-blown V-shaped recovery. If you look at the last 6 months, industrial production is up over 8% at an annual rate. Retail sales are up 7% at an annualized rate. The consumer price index is increasing at about 2.5%, and the PPI is growing even faster than that. It is very clear that they're about to get way behind the curve. And I think that's what the price of gold is telling us. I think that's what commodity prices are telling us. I think they have to take their foot off the accelerator, and I think they probably already should have done it, but they need to do it sooner rather than later.
John Lonsky, same question.
All that being said, home prices, though they may have increased somewhat over the past several months, are expected to decline yet again. Commercial real estate prices are plunging at a record-breaking pace. And it may be true that commodity prices are higher, but wages continue to slow, and that brings into question whether or not consumers can afford much higher prices. If consumers can't afford higher prices, real economic activity will suffer. So I think the wait for a rate hike, which is not necessarily a bad thing, may be a little bit longer than commonly thought.
Is it possible that the U.S. as well as other countries are just going to be forced into raising rates, perhaps, so early that they do choke off any economic recovery? I mean, I'm just looking, Brian, at the headlines out of Britain today. Sure. Consumer prices there are rising at their fastest pace since May. That economy is still struggling mightily, and they might have to raise rates.
If you go back to the early 1980s, Paul Volcker was holding interest rates very, very high, even though the unemployment rate was high and lots of people were worried about the economy. But that's the right thing to do. The best thing the Fed can do is keep inflation or prices stable. That's really the only thing they can actually accomplish, because all they really hold the handle for is the printing press, the money printing press. And if printing money actually could create wealth, if that's how we created wealth, then we might as well just let everybody counterfeit money, because it doesn't hurt. But see, what happens in the end is that by printing money to try and keep the engine going, all they do is create inflation. All they do is undermine our growth over the long run. And I think that's where the danger lies. What we need is entrepreneurship, innovation, creativity. That's where we get wealth from, not from the printing press and the Fed.
John Lonsky, if they had to go off of one number to make this decision on interest rates, and they had a choice between two, one would be the inflation number and one would be the unemployment number, which is the one they should go off of to make the choice?
I think they should go off the unemployment number, but my own view is they're going to be paying a lot of attention to housing. And once residential real estate stabilizes sufficiently, I look for the Fed to begin edging interest rates higher soon thereafter.
Thanks very much, John. Brian, appreciate your time this morning.